Welcome to The Explainer. Today, we're going to demystify personal loans. They can feel like this big, scary financial maze, but they don't have to be. Think of a personal loan more like a powerful tool that, once you really understand the rules, can actually help you reach your goals.
I mean, let's be real. Most of us have been there, right? That moment when the roof starts leaking, or a surprise medical bill shows up, or maybe you're just staring at a mountain of credit card debt and wishing you could consolidate it. That's the exact moment, that gap, where personal loans are designed to step in.
So here's our roadmap for today. We're going to start with the why you'd even need a loan. Then we'll get into the what, the different kinds you can get. We're going to break down the real cost, then pull back the curtain on how lenders actually see you, show you how to spot the bad guys, and finally give you the strategies to pay it all off faster.
Okay, so let's start at the beginning. It all kicks off with that financial squeeze. It's that moment when life just happens, and the money you've got on hand simply doesn't cut it. It's that uncomfortable gap between your bank account and your needs that really starts this whole conversation about borrowing money.
Now, a personal loan can be an amazing solution, but it is definitely not a one-size-fits-all kind of thing. They really come in two basic flavors, and knowing the difference between them is probably one of the most critical things you need to understand before you even think about signing on the dotted line.
It really boils down to just one word: collateral. Okay, so with a secured loan, you're putting something valuable up as a guarantee, like your car or your house. This makes the lender feel a whole lot safer, so they'll usually give you a better interest rate. But with an unsecured loan, there's no collateral. It's all based on trust. Basically, the lender is betting on your track record to pay them back.
All right, so you've got a handle on the type of loan you might need. Now for the really big question. What is this thing actually going to cost you? And here's a little insider tip for you. That interest rate you see in big, bold numbers? Yeah, that is almost never the whole story.
So first up, you have the interest rate. It's pretty straightforward, right? This is just the percentage the lender is charging you for the privilege of using their money. It's the main thing that determines your monthly payment.
But, and this is a huge but, the number you absolutely have to burn into your brain is the APR. Just think of APR as the all-in price, the true cost of your loan. It's not just the interest, it's the interest plus all those other little fees the lender tacks on. Seriously, if you only look at one number when you're comparing loans, make it the APR.
And look at this. This shows you exactly why it matters so much. A lender might advertise a $15,000 loan with a 13% interest rate. You might think, okay, not great, but I can handle that. But then, bam, they hit you with a nearly 10% origination fee, which is almost $1,500. All of a sudden, the real cost of that loan, the APR, has jumped up to over 16%. That's a massive difference over time.
So how in the world do lenders decide what APR to give you? Well, it's definitely not random. What they're doing is creating a quick financial profile of you, and they're laser-focused on two key numbers to figure out how risky you are. The first one, the one everyone knows, is your credit score. Just think of it like your financial report card. A high score tells the lender, hey, this person has a great history of paying people back. It's a simple formula. The higher your score, the less risky you seem, and the better the rate they're going to offer you.
The second number is your debt-to-income ratio, or DTI. Now that might sound complicated, but it's really not. All it does is measure how much of your monthly income is already going out the door to pay other debts. Lenders want to see if you can realistically afford another payment. For these kinds of loans, they usually look for a DTI under 40%.
But here's the best part. You are totally in control of this stuff. Your financial profile isn't carved in stone. Just by doing simple, consistent things like always paying your bills on time and keeping those credit card balances low, you can actively improve your profile and get way better loan offers down the road.
Okay, so once you know where you stand financially, you have all the power. And that power is your #1 defense against predatory lenders. And trust me, they're out there, and they love to target people who are in a tough situation.
You absolutely have to know the red flags. Things like balloon payments, where there's this impossibly huge payment waiting for you at the very end of the loan. Or loan flipping, where they keep pressuring you to refinance just so they can rack up more fees for themselves. These tricks aren't built to help you, they're built to trap you. You've got to know the signs.
All right, let's wrap this up on a much more positive note. Once you've got a fair loan, you are in the driver's seat. So let's talk about how you can take control, knock out that debt ahead of schedule, and save yourself a whole lot of money while you're at it. There are a bunch of proven ways to do this.
You could try making bi-weekly payments instead of monthly ones. It's a clever trick that sneaks in one whole extra payment per year. Got a bonus at work or a tax refund? Throw it directly at the loan principal. You could even refinance later on if your credit improves and you can snag a lower rate. Any of these strategies can cut months or even years off your loan and save you hundreds or thousands of dollars.
So what's the big takeaway from all this? It's that knowledge completely changes the game. Without it, a personal loan can feel like a trap, for sure. But when you understand the different types, the true cost, how lenders look at you, and how to stay in control, it stops being this big, scary thing. It becomes what it's supposed to be, a predictable, manageable tool that you can use to build a better financial future. It's all about knowing the rules.